Hello, my name is Tuf. Welcome to my channel. Long time no see for all the people that followed me in the past. I'm glad to be back, and today I'd like to share with you some work that I've done recently about one company that actually I'm owning. And I'd like to use this as an opportunity also for you to understand how we build an operating model and how we end up with a share price estimation. So I'm not a financial advisor. So just consider that as just maybe educating a video and no advice on any buy or sell. So the ticker today is a Smith Micro, SMSI. I've been inspired by this ticker by following a group of research, which actually include one of the main actors, who's Mark Gomes, and this person has helped me a lot to let's say by watching this video to develop some operating model development skills. So I will put just the link on the description if you're interested by his methodology. Uh, it's quite complementary. It's quite good. So what is Smith Macro doing? They are a SaaS company, so software as a service company, and they develop basically an app for mobile phones that can be sold kind of to the mobile carriers such as T-Mobile, AT&T, Verizon, and these companies can deploy that then to their clients. And this app mainly contains different, let's say, tools, such as allowing, for example, if you're a parent, to locate your kids, to do also parental control. So, for example, if you want to stop the Wi-Fi or the internet after such time or during dinner, it can be done also. And they also have different modules, such as the drive detection modules that will, let's say, quantify or evaluate, for example, your kids' driving skills. So all this is just inside one and only app that actually the carriers, the mobile carriers, will deploy to their client customers. Recently, they have had a green light with T-Mobile, and this app is now on the stores, Google Store and Apple Store. What does it mean for Smith Micro? It means that it's going to be additional revenue. And today, I'd like to build an operating model with you and put in light what the revenue could be in the next quarters, and then see what what share price could that result. And that's why I like first to go back in the step number one, and to actually explain for those who are not completely, let's say, comfortable with this all this analyze, how the revenue is split. So, for example, if you have a full revenue acknowledged by a company, you can split this revenue and then get what's going to be the net income, basically the cash. So here is the split of the revenue. So, for example, the first let's say item will be what we call the cost of product, which is actually referred to the gross margin. So when they say, for example, 90% gross margin, it means that the cost to produce the final product is 10%. So the gross margin, the remaining margin is 90%. Then after, you will also have the operating expenses, sales, general and administrative, research and development. And then when we subtract all of this, what is left is the operating profit. So inside the operating profits, basically it's the income, but out of it there will be a tax taken. So the real net income that is left is, for example, here I took an example: 20% income tax of the operating profit is remaining 80% of the operating profit. So now, how do we do to estimate the share price of a company based on the cash that they generate? It's basically you take this net income, you divide it by the number of shares. It will give you a earning per share, or what they call EPS. And basically, on this earning per share, you can apply then after a ratio. So for example, if you want to have a 10% yield, you divide 100 by this 10% yield, and it gives you a P ratio of 10. If, for example, you want like a 5% yield, um, it will be 100 divided by 5, which will give you a P ratio of 20. The typical P ratio that have the SaaS companies, such as Smith Micro, would be around 20, something like this, 20, 30. And from this EPS, we can estimate the share price. So what we're going to do just after is basically estimate the revenue based on the new contracts that Smith Micro received, and maybe the new subscribers for this app that will generate additional revenue. We need also to know what might be the future or the final gross margin that is targeted by the company. And also we need to do an estimation of the future operating expense, for example, the SG&A and also R&D. In the case of Smith Micro, we know that the product has been developed for many, many quarters in the past. So we don't expect to have a much like bigger increase in terms of R&D and SG&A expense. So, for example, we'll go with on the assumptions a bit later, but this will be pretty steady, flat. Also, for example, the income tax, how do we know how much the company will pay? It depends. For the case of Smith Micro, because they lost so much money in the past, they were not profitable, cash profitable, they accumulated what we call net operating losses. So basically, around like $300 million of net operating losses, meaning that when they will start generating net income, they will not be forced to pay any income tax until the net operating loss are cancelled. So this is to give you very, let's say, the big picture of how do we do to estimate that final value, which is the share price that we want to. We need a target, and that will help us to build confidence in the future story of Smith Micro. So I just summarize here all the assumptions and basis that we will work with to estimate to build our operating model. Just 1 second. Okay. So the first one is actually is a basis, not an assumption. The contract for every so provided, for example, by T-Mobile is going to be $3 per month per family. So that's going to be a basis. We need to know now how many families will subscribe to it. The gross margin, that's what we were talking about regarding the cost of products, that's an assumption that will be increasing from 72% actually to 87%. 87% is based on some comments from the conference call that they provide on quarterly basis, and that they will target 87%. As I was mentioning, for example, Smith Micro, their app has been already developed quite a lot, so we don't expect like a major increase of operating expense. So I just consider 1% increase quarter over quarter. So it's almost flat, but a little bit more increase, sorry. Now in terms of market penetration, so here is the most, maybe one of the most important parameter to define in this operating model is how much penetration there will be on the US market. And I put a date, which will be, for example, in 2 years' time, Q4 2024. And this one, actually, they had already a contract with Sprint in the past that was absorbed then after by T-Mobile. And at that time, Sprint had 7% of penetration, market penetration. So here, actually, it's, when I consider 3% is really a conservative number. Knowing that T-Mobile might have a better, let's say, advertising skills than Sprint. Um, so when I consider the entire US market, it's because they signed a contract with T-Mobile, but also AT&T and Verizon. The app will be deployed on their on these carriers probably by the end of year. So that's why I consider the entire US market as the basis for the 3% estimation. So how does it lead? So there are 122 million US households. Why I consider this? Because it's based on the family. So you cannot just say based on the number of each subscriber, but more based on the family numbers. And if you consider 3% of the entire US market, it will lead to 3.6 million subscribers. Here, the idea is I like to say, okay, basically, by Q4 2024, they will reach this 3%. And that will help us to define actually the number of subscribers per quarter, which will be, based on this, around 330,000 subscribers per quarter. Also, I will not consider any international revenue from any other company. We know that they are in discussion with Vodafone and other clients, but just to simplify the operating model, we will not consider additional revenue from overseas. Also, as I was mentioning, no tax over the operating income because they have accumulated a net operating loss over the last years around $200-300 million. Also, I don't consider in the operating model any share dilution because there will be a positive cash flow positive soon, and also they got a credit facility of $7 million recently, so that will avoid them to dilute the shares for no reason. Also, bon, this is not the most important, but Smith Micro has two other business, Compute and what is the other one? Compute and ViewSpot. And well, these ones they don't contribute really to the revenue, so even they are supposed to decrease. So I will put on top of it a small revenue from these two other parts. So that's going to be the final outcome. I wanted to show you directly what would be expected if we applied these assumptions. Then after I give you a bit more detail on how to build the operating model. But based on the PE that you apply, PE ratio 10, 20, or 30, you might have a price target between $14 and $42, which actually would represent a big upside even for at the lowest PE, which is 10. But we will go a bit more into detail through the operating model so that you understand how we proceed. So here is our operating model. It's a bit messy, but I provide you after a more interactive way to show. And the concept here is every quarter. So from Q1 2022, everything that is in red is actually an assumption. So I built already the model from 2019, but I only show from Q1 2021 to Q4 2024. As we mentioned in the assumptions, the main assumption is that by Q4 2024, they will reach 3.6 million subscribers. So that's why I arranged so that the quarters, let's say the extra number of subscribers per quarter on a linear basis will increase, such as at the end you have these 3.6 million subscribers. So the increment for every quarter is 333,000. And I consider that SMSI will receive $3 per month per family. And then from there, you can estimate the total revenue per quarter. And also on the sales generative and administrative and R&D, I put a 1% sequential growth quarter over quarter. So that's why, for example, on Q4 2021, it was 11, and it will gradually increase slowly over 2024. But it's almost flat. I just considered like a very slight increase. Same for SG&A. Based on this, you just take the revenue, also the gross margin, which I explained that it goes from 72 to 87 gradually also. So I just did manually 81, 82, 85, 86, 87. And then you get your gross profit, which is just, for example, 78% of 30 minus SG&A and R&D, and it will give you a kind of a net income. I don't apply any tax on that because, as I mentioned, they have net operating losses. Based on this, after we divide by the number of shares, it will give you earning per EPS, earning per share per quarter. And after when you sum it up, you have the earning per share per year. You multiply by the P number that you want. For example, here is 20, and you might end up with a share price. As you can see here, if the EPS is negative, you come up with a negative share price, so it doesn't make a lot of sense. But here the concept is that if we build an operating model, it's actually to be able to see in the future what the earning will be, so that even if it's not a profitable company today, we can see where it's going to go in 1 or 2 years. Here it's quite difficult to digest on a table. That's why I made the next slide. And this one actually for me is like maybe the most important slide of the presentation. It gives you a clear idea of where we are and where we will be in 2 years' time if the assumptions are right. Okay. So here is quarter by quarter, and I put actually the total revenue, which is in white. And after, based on what I was showing you at the beginning, when you have the revenue split, you will have all these cost of product, SG&A, R&D, and then what is left is the net income or the loss. And as you could see, over 2019, Sprint was marketing the app because they had a contract, and actually it went very fast. And Smith Micro generated a sequential growth quarter over quarter because the number of subscribers was quite important. And at that time, the penetration of their number of clients was up to 7%. Then after we had the COVID plus T-Mobile acquiring Sprint, and we definitely started losing some, let's say, some revenue because, because there was no more additional subscribers. And obviously, starting Q1 2021, we're starting getting negative income. Also, as you could see here, from Q1 2021, this is where they started hiring personnel to develop the app to make it a bit, let's say, to develop it, yeah. And obviously, this generated a temporary loss. So 3 million, 6 million, 7 million, 8 million per quarter. Sorry, 7 million. And today we are here in Q1 2022. In Q2 to 2022, this is where we expect T-Mobile to make, let's say, big marketing efforts to promote the app and then to boost the number of subscribers. That's why on my operating model, I start the number of additional subscribers in Q2 2022. So it should be now. Okay. And from there, the revenue obviously will start increasing. SG&A increased slightly, R&D increased slightly, and only in Q1 2023 we will start having positive net income. At that time, also AT&T and Verizon will start launching also the SafePass application to their clients. so that we provide a boost on the number of subscribers. But 88 T-Mobile will be already, let's say, way sufficient to start boosting their revenue already in 2022. And as you can see over the next quarters, if we continuously see, like say, a jump in terms of subscribers to reach 3% of the total US market, we will generate now a significant net income, up to $19 million per on the last quarter, Q4 2024, when we achieved the full 3% market penetration. Here it's a similar view of the precedent slide, but here by ratio, by showing if the revenue is 100%, how much would be the net income? And obviously, when they start investing in the product, obviously they put a lot of effort in R&D and SG&A. But as the revenue increase, the ratio of R&D and SG&A will start decreasing slowly, and the net margin will reach 40%. I think Smith Micro didn't guide for so much, maybe 30%, but okay, maybe 35%. So the final, let's say, 2 quarters might not be completely accurate as per the guidance, but who knows? So now that the concept is how do we estimate a share price? As you can see, if we start investing here, definitely, and then just look, for example, at Q1 2022, it's difficult to put a price target. Maybe we look at the price to sales, something like this, but it's not really, let's say, informative for us. So that's why we build the operating model so that, let's say, in the future, when we know that they are reaching their final target, they might be at this position where they earn $19 million per quarter, which will be 80 million per year on a run rate. And based on this net income, if I divide it by the number of shares, which actually is number of shares 54, 80 divided by 54 will give you around a bit less than $1.5 per of earning per share. And then after you can multiply by the P ratio of 10, 20, and 30, and it will give you an idea. On the next slide, what I will show you is also, I played with the market penetration, US market penetration. So I changed the extra number of subscribers per quarter to reach from 2% to 7% of the total US market penetration. And the target is just basically to give an idea of how much, how low the target can be and how high can the target be. And based on the different PE, that's where we end up with this table. So as I mentioned, I just changed the number of subscription per quarters from to reach 2% by Q4 2024 up to 7% in the base case, which was the type of market penetration experience in the past with Sprint. I used 3% in the model before just to show a conservative base case, but it might be between 3 and 7%. And if it's really successful, why not more? And based on 10, 20, 30 P ratio, that's the share price. So you see the price target might be different. And here I summarize that in the entire table. Today the share price is $4, so you can estimate that basically you could go between 7 and in the very, very best case, more than $100. The truth might be in between, and that's why, depending on the market, depending on the success of the application, we might possibly be above $10 or more in the next 2 years. So this type of price targets, unless you really do it yourself, it's quite difficult to be confident in somebody telling you, okay, I have the target is $30 because I like the company and it's good, it's going to make success. And it's always good to add some mathematical uh, maths behind just to know where we're going. And also this story, as I mentioned, it might change in the middle. Maybe the app will be even better. Maybe they will have additional international revenues and things like this. And this app, this model can always be updated quarter over quarter because you know how many subscribers get in and how successful the story is. But at least it gives us like an idea of, okay, is it a good deal to start investing in this company or not? And to my mind, yes, it is. Okay, so in conclusion, I think it's an interesting potential for this company and exciting in the next 2 years. Considering that the share price is actually very low at the moment, it's at the lowest over the last I don't know, maybe year or two. It's to me it's a good entry point. Uh, what we need to follow basically is to confirm that our operating model is okay. Is the number of additional subscribers per quarter, also the gross margin, where is it going to, and also the OpEx increase. So is it only just 1% quarter over quarter or even more because they need to develop more tools and more tools? Also look into international deals maybe just to see if there's a potential upside on the story of Smith Micro. And yeah, see at the end if the percentage of subscribers is really what we think or not. And that's the reason why I think it's an interesting exercise that you can do. And if you're interested, I can help you, but you can start really building the basics on Excel by putting the number of subscribers, number of subs per month, like the price per subscription per month, and you do just a simple multiplication. You can have an estimation of the R&D and SG&A, and then after divided by the number of shares, which gives you the earning per share, and then after you multiply by the P/E ratio, and it gives you an idea. And I think it's good to play. Uh, the more you play, the more confident you will be, and the more you will be able to take your own decisions. I think it's very important because these days a lot of people, a lot of pumpers are trying to get us on every stock, every different stock. And if you don't know what you own, then you will start selling at the first decrease in share price. So this tool is like a tool for your own decisions. And this example on Smith Micro, I think is a great example because if we look at the situation today, it doesn't look good, but over the next 2 years, it looks fantastic. In the meantime, the story might change, might be better, but at least we know what direction we go and what share price to expect, which I summarize here. Okay, so I hope you enjoyed. Sorry for my speaking, French speaking or English speaking, which is average. Long time no, I haven't done any video, so pardon my sometimes my hesitation. I hope you enjoyed, and if you like this type of video, just don't hesitate, and also don't hesitate to look at the videos from Mark Gomes. I think he's really great educative videos, and he's an expert. He's been in the market for a long time, so not like me. But I like to share this with you because it's also a personal exercise. The more you share, the more actually you can integrate the technique and be more comfortable. So I hope you enjoyed. I did, and I see you soon. Bye bye.